Hi, everyone. It's Kirk here from Tridac Mortgage. I'm actually coming from my basement, my man cave, and I'm joined by, luckily enough today, my principal broker, Christopher Mulder. Hi,
Hey, good
Chris.
morning, Kirk. Man, I love that man cave. What do you got in the back there? You got some hockey pictures, baseball pictures, all your faves.
All kinds of sports memorabilia, boxing, punching
Yeah,
bag, all
yeah,
kinds of jerseys over my right shoulder.
yeah.
I've been collecting for a couple decades, 3 decades actually.
Right on.
So
And that is that punching bag getting any good use, or is it just sitting there?
there's some days it gets more use than others.
Take out the COVID aggression on that thing.
Oh yeah, for sure.
Right on. Very good, Kirk. Well, thanks for having me this morning, and I'm looking forward to chatting with you.
Yeah, I thought we could discuss the markets during COVID-19. I've been handling a lot of interesting questions, and maybe some of my followers would like your opinion on a few things.
Sure,
Um,
gladly.
okay, so like, the first major question that I've been getting a lot of is what changes has the market seen because of COVID-19?
Yeah, well, in regards to the mortgage market, we've had to adapt just like any other business to the changing circumstances. And so, how lenders are working, how they're pricing mortgages, how they're assessing risks, whether people have maintained their jobs or lost their jobs, all this is new. How to even deal with signing of documents at a lawyer's office if we're supposed to be social distancing and a lawyer is required to identify somebody in person. How is the business and the mortgage business adapting to that? So there's been a lot of change. And from a view of 10,000 feet, business has continued. It's adapted really well. It's been really resilient. And in many ways, it's business as usual, and we can talk about some of those details.
Okay. There has been quite a lot of rate talk, and I know the media is blowing up the fact that rates are low, low, low. But we know that that's not true at this time necessarily,
Right.
correct?
Right. Yeah. It's an interesting thing, Kirk, because we would expect interest rates to be low due to the outbreak. Well, the outbreak is a health crisis, and then that has led into the shutdown of the economy, which is now leading to a financial crisis. And for all intents and purposes, I think everyone agrees we are in recession. So during times of recession, interest rates are low. And when we talk about mortgage rates, we're talking about fixed and variable rates. And there are different mechanisms that affect them. But for both, those underlying mechanisms would dictate that interest rates are low. So for fixed rates, it's the bond yield, which is very low. And for variable rates, it's the Bank of Canada prime rate that is low. So that is true, but lenders have had to artificially jack up the pricing due to increased costs for money. So because of the uncertainty, money has been harder to come by. And even though the fundamentals that set interest rates are low, due to the uncertainty, lenders have had to increase the spreads on both fixed and variable rate mortgages. So certainly in March and all of April, interest rates were higher than we expected. So when it came to conversations about interest rates, the feeling was really that we should have lower rates than are currently available in the market. Now, as we head into May and the tough road ahead, we will see rates starting to ease. And in fact, already in the last week, we have seen drops to interest rates, both fixed and variable, to levels that we would expect as we head into the ongoing recession now. So for example, a 5-year fix went from April 1st to May 1st from about 3% to about 2.5% today. And variable rate mortgages went from 2.75%, actually 2.65 to be exact, down to about 2.25%. So about a 0.5% drop from the beginning of April to the beginning of May.
Okay, so although it's unlikely, variable rates are based on the retail prime. It's probably unlikely that the prime rate will get lowered to zero, and if it does, that doesn't mean free money.
Yeah, that's right. I mean, the Bank of Canada at the last meeting in April, I think it was April 6th off the top of my head, they came out and very clearly sent an indicator to the market that they will not drop the prime rate any further. So we shouldn't expect the prime rate to drop beyond 2.45%, which it is today. But what will change is the discount offered off of prime, because a variable rate mortgage is typically a formula of prime plus or minus a certain factor. And what's changing is the discount off of prime. So right now we're looking at about prime minus 0.1 to prime minus 0.25.
Perfect. And I've heard that, well, I've been working with it, the qualification rate actually changed. I know the stress test from 5.19% to 5.04. Are we expecting a little bit more of a drop with time? I know they were going to introduce lax stress test rules on April 4th, right. I believe, to have it, the contract rate plus 2%. I know it's been delayed. Do we expect another change with qualification at this time?
Yeah, that's a good question. Pre-COVID, there were some announced changes to mortgage qualification rules that were going to relax things a bit for us and make it easier for home buyers. That has been put on hold due to COVID. And what has been changing, though, is the underlying Bank of Canada qualifying rate. And just as a reminder, that qualifying rate is determined by the Bank of Canada takes an average of the posted 5-year fixed rates offered by the big 5 banks. So as 5-year fixed rates, as the posted rates, not the discounted rates, but the posted rates start to come down, we will see a drop to the qualifying rate. And I would fully expect that in the next 30 to 45 days, we would see further drops from the 5.04% that it is today to below 5%. And every time it drops, it means that borrowers can qualify for more and more mortgage money.
And the last major thing COVID has started was deferrals. I've given a lot of advice to people on how to go about getting a deferral. It's not necessarily the best option. I know some people are complaining a little bit about still having to pay the interest on those. Do you have any advice to someone considering a deferral?
Yeah, well, listen, I mean, the deferral can be a lifeline in a time of need. So if you must choose between putting food on the table and meeting your family's basic needs or paying a mortgage, I mean, it's an easy decision. Take the mortgage deferral. However, if you're looking at the mortgage deferral as an opportunity to take a break and you can, in fact, make the payments, my recommendation would be to continue to pay the mortgage. Why is that? Because when you defer your mortgage payment, you're actually adding to the balance of your mortgage, because all the interest that's accumulating and isn't being paid simply gets added to the balance. So in effect, you're increasing the outstanding balance of your mortgage, which is costing you more in the long run. Now, advice for anybody who has to take advantage of the deferral program would be to think about it in terms of saving enough for at least the interest payments of your mortgage. So let's say each monthly payment for a mortgage is comprised of 2 things: principal and interest. So when you defer your mortgage payment, you're deferring both the principal and the interest repayment. But if you're able to, the recommended method would be to save the interest portion, which is roughly 40% of each month's mortgage payment for a 25-year amortization. So about 40% of your mortgage payment, set it aside as savings if you can. And then at the end of the deferral period, make a lump sum payment towards your mortgage to pay the interest that's accumulated, so that way you can pick up where you left off.
Perfect. Okay, so I'm going to move on a little bit here. I'm dealing with a lot of people that have lost their jobs, and there's two scenarios I'd like to address. What do I do if I've lost my job and have an existing mortgage, or I've lost my job and I was planning on getting a new mortgage?
Right. So if you've lost work and have a mortgage, and I think the most anxious situation is where that mortgage is coming up for maturity or renewal in the next 6 months. There isn't really too much risk there for you, because your lender, provided that your mortgage is in good standing and you haven't been missing payments prior to COVID, will extend the renewal to you. And when your existing lender renews the mortgage, there is no need to requalify for that mortgage, right? So they'll send you a renewal offer. You sign back that renewal offer. There's no need to send a credit check. There's no need to send confirmation of income. Life just continues. So I've been addressing a lot of those questions as well, Kirk. And to be clear, anybody whose mortgage is up for renewal will be able to renew that mortgage without stress. Now, it's a different question if there's a need to refinance the mortgage, meaning that they want to pull out equity, maybe to consolidate debt, to do renos or whatever it is. At that point, when we make a new mortgage application, lenders will expect to see that you are back to work. So it's really important that your work situation evolves, and nobody is in control of it at the moment. But without income and without regular paychecks coming in, borrowers will find it challenging to do anything with their mortgage. And that includes refinancing or making an offer or getting a mortgage to buy a new property. Okay. Now, there are some exceptions. If you've been placed on furlong, or you have a job but aren't earning income, there are all kinds of situations that have arisen out of the outbreak and the shutdown of the economy. There are some alternative type lenders that we can look at in a bind who will consider your return to work income and understand that, while you're not pulling a paycheck now, you have had a job for X number of years and you will be going back to work. So there is some flexibility there, but most of the what we would call A-type lenders are going to have a hard time qualifying borrowers.
And the next major thing people are asking is, okay, I've been saving for a home and 2020 was the year. I'm a first-time buyer. Is now the time? Should you wait for more inventory, live through this?
Yeah, that's a great question, Kirk. When it comes to home buying plans, I mean, let's assume that you are fortunate enough to be pulling the income in order to qualify for the mortgage. So when it comes to actual timing to buy, looking at the market, we're starting to get the color of what the market looks like right now, because we get data in arrears, right? The data from March is just coming out, and we're starting to get information from April. And by all accounts, home sales, the volume of sales has come down, the volume of listings has come down, but the prices haven't. In fact, there are still bidding wars. Homes are selling. And so we're not really seeing a real crash to the market to really indicate that it's a buyer's type market. I think what has happened is the market has kind of stabilized a bit. And we talk about it, a buyer's market and a seller's market. And at the moment, I think the market is in equilibrium right now. And there's opportunity for buyers to come in with less stress than there would be pre-COVID. Because pre-COVID in February and early March, we were setting up for a banner year for real estate, which was going to make it almost impossible for first-time home buyers because the prices were accelerating so quickly. Very challenging market circumstances. So to kind of summarize and address the question that you asked, is it a once-in-a-lifetime opportunity? We're not seeing that yet. But I do think the conditions are favorable for home buyers And in my own business and with my own clients, I am seeing first-time home buyers coming to market and looking for pre-approvals moving forward. So people aren't being scared away. And I was looking, I think it was the Financial Post yesterday, the cover page had an article about the resilience of real estate in the GTA, and that there's still, despite everything going on, there are still multiple offers on properties. So go figure.
So if you're one of the lucky ones that maintain your job, it's still time to continue on the path towards buying at some point at this time.
Correct. I think it's a good opportunity, because pre-COVID, you know, if you were shopping around, you saw something that you liked that came onto market, you would have to rush into it to get your bid in before anybody else, and you'd be worried about 10 other couples were trying to bid on a property. So things would get irrational and emotional. Whereas now there are less shoppers in the marketplace, so there's less likelihood of a bidding war, which is good. That's favorable for borrowers or first-time home buyers, I should say.
And the last major thing I've been getting is I have existing mortgages, and it's not time for renewal, but should I? Fixed and variable scenarios, both included here.
Yeah, I think the advice for interest rates right now is that if you're in a variable rate mortgage, don't change anything. And if you're looking to take out a new mortgage, whatever the scenario is, because you're buying, because you're renewing, because you're refinancing, you should be considering a variable rate mortgage as well. And the reason for that is because we are now headed into a prolonged period of recession where the Bank of Canada will not be in a position to increase the prime rate. In fact, last time we had a real drop in the market like this was in 2008 with the housing crisis and the financial crisis. And it took, I can't recall off the top of my head, but I think it was 5 to 6 years of a low prime rate before the Bank of Canada started increasing. So variable is definitely the way to go. If you have a fixed rate mortgage and you're locked in over 3%, I think there's a conversation to be had to consider switching from fixed to variable, capitalizing the penalty, and then taking a low variable rate mortgage. I've been running that scenario for a lot of clients, and it seems to be working to their favor. I mean, on a $250,000 mortgage, these are just the numbers off the top of my head of a client that we just reviewed. By doing a refinance, they had a rate at 3.25%. We now give them 2.5%, and they're saving $5,000 in the 3 years remaining in their mortgage. So yeah, there is opportunity. Now, if you have a fixed rate that's under 3%, I don't think the math works for you. But there might be other reasons why you want to refinance, to consolidate debt, to do some renos to a property, to do some investing. So you can certainly justify doing a refinance and moving into a variable rate mortgage.
There's still lots of options out there.
Yeah.
through this.
Yeah, absolutely. And I would encourage, you know, anybody who has those types of questions, you know, reach out to you, Kirk. You know, you've got that information, you've got that know-how. So I think it's really valuable what you can offer to your clients. Yeah,
I would appreciate it if anybody has any questions to reach out to me. And behind me, I've got a great principal broker here. pretty awesome guy.
Cheers. Cheers, Kirk. Very good. Awesome.
All right. Well, thanks very much for taking the time out to discuss this with me today.
My pleasure, Kirk. And I can tell you are probably jonesing for some sports to watch in that man cave there. So hopefully it comes back soon.
I hear golf is going to be the first thing back. So
it's perfect for social distancing.
Exactly.
All right, Kirk. Talk to you later.
Thank you. See you.